So what we're going to do, everybody, we talk about the market when it gets a little bit crazy, and everybody starts talking about shorting and inverse ETFs and all of those sorts of counter actions that you can get in the market. So I thought I would just do a little bit of talking about shorts and how to scan for them. We'll talk about some tracking ideas about how to try to find behaviors that will be setups for shorting. We'll look at the setups. And let's go over what the actual shorting is. I mean, what really happens. There's a lot of, like I say, there's a lot of talk about it, but it's interesting to know the mechanics of it, because that will also sort of give you some ideas for what can possibly go wrong when you go start shorting. So we'll kind of jump into it first. So what is shorting? So everybody talks about making money when the market goes down. So what shorting is if you've got a stock that's, say, at $20 a share, and you think it's going to have some problems and it's likely to go down, and you want to make some money off that, when you open your trade, you essentially have borrowed, let's say it's 1,000 shares at $20. We're going to borrow 1,000 shares from our brokerage, and we're going to basically go out and we sell that on the open market, and we now have $20,000. Of course, once we borrowed it, we're going to have to pay it back. The idea is that as the stock continues to go down, 17, 15, wherever, eventually we're going to say, okay, we've made enough money. I'm going to go out and close my position. I basically go out and I buy shares on the open market at 15, and I replace them. I return them, give them back to the original owner, and I've sold at 20,000 and I've bought at 15, so I've made $5,000. So I've basically made the money of that depreciation over that amount of time. And so that's the basics of shorting. And you hear other things like short interest as to how many of the shares that are out there are actually borrowed and shorted. I mean, you'll have certain companies like Tesla where you hear about the short interest being very high. These are typically companies where there's a larger expectation that something's eventually going to go wrong, and it's going to go really wrong, and the price is really going to drop. So you hear certain hedge funds will always be talking about companies like Herbalife and some of these sorts of companies where they think there's something really kind of fishy maybe going on, or that the demand is going to fall apart, and they want to try and make money by watching it drop. So that's sort of the theory behind shorting. And so what we're going to do is come up with a few ways with the scan engine to try and find some of these setups. And we'll look at a few different, like I say, behavioral patterns that we want to try and spot and take advantage of. So I've got my scan here. Actually, I want to go up to the user interface here. We're going to get short. And so what I've got here is a scan that's got sort of a base at the top. So I'm going to basically be looking for stocks that have about 200,000 shares a day. So I want to get something with a lot of volume, because you want something that's fairly liquid, because if you have to get in and out quick, you don't want the thing moving on you. We're going to go for stocks over $10. I'm going to limit it to the US. And within the scan engine, ETFs are sort of considered stocks. They trade daily, they have volume, so they behave like stocks. So, but I'm not looking to try and short an ETF, because that's a much broader thing. It would have less action, less. It's more diversified, so it won't have as big a swing. So I'm going to look at avoiding the ETFs. From there, I've just got, let's pull this out a bit. I've got just a number of different ways of things to look for. So I've got a Wyckoff washout, relatively awful, 0 for 7, going down, Bollinger breakdown, and percentage peril. And when I was writing these, I felt like I was announcing like Jeopardy channels or something. So we're going to go through each of these, and each of them has their own sort of properties. So I'm going to uncomment these guys. And we're going to go ahead and let's scoot this back up, check our syntax, run our scan. So Wyckoff, for those who aren't aware of it, if you're interested in Wyckoff theory, Bruce Fraser has a blog, and he's an expert. He teaches this at Golden State University. The theory of Wyckoff is that initially there's some capitulation selling. Tom had this the shares earlier, the tailored, and that had a bad earnings report, and it gapped down hugely. And that's sort of the beginning of a Wyckoff process. And the Wyckoff can take quite a while to run through its process. But it's that initial gap down that may give us some ideas. And of course, here we found it. We've got this, the exact stock that Tom was talking about. You see this huge gap down on massive volume. So that's a first place to start of look, because you've got the initial reaction, and very frequently it's not going to be the end of it. It's probably not going to bounce back up to 20 tomorrow. So this is a way to start to find things that have this pattern of massive selling, usually on an earnings release or an update to earnings on expectations. Sometimes if you're looking at like a pharmaceutical that misses an FDA trial, some big news that affects the stock, you'll get this sort of action. So that's one of the setups we can look for. What will typically happen on one of those is we may see this initial drop, and we may see a little bit of a recovery, sort of a dead cat bounce, as it were. You may see, maybe we'll get a little bit of volume on the upside tomorrow. But if we see that thing break down again on, say, in this case, below down about 14, if we see it break there, then we can maybe have an expectation that, we're not done. We're going to be on a slide. So this is a stock you may want to put into a chart list as potential shorts. I mean, we may not want to go short things right off the bat here. We may want to kind of watch and see them they develop. And we may want to watch this and see if we get a little bit of up action, and then wait again for a down action below this whatever low we put in today. So that's sort of using the Wyckoff approach of finding a large gap down. I'll turn this guy off and we'll move down to the next one. On the upside, we're often talking about, and I know Tom talks about this a lot, relative performance relative to the S&P, relative to the industry, relative to the sector. On the upside, you want to see something that's outperforming its brethren, its brothers and sisters. You want the best of the best. So what we're going to do here is we're going to just flip everything over. And what we're going to try and do is we want to find something that over the last 20 days, which is about a month, and of course, this beauty of the scan engine, you can tweak that number to anything you like. We're going to find something that's worse than the S&P. It's worse than its own sector, so like the XLF or the XLI, industrials or financials. And we're going to find something worse than its own industry, so maybe insurance or banks or mining or whatever. So we're going to run that. We're going to get a lot more of them there, because that means there's a lot of stuff out there that's underperforming the S&P. And so we probably, on something this big, we've got 800 results. We probably want to put a few more caveats in here, because personally, I don't have time to sift through 800 of these things. But you can see this one actually doesn't look too bad. But if you scan through some of these and make your way through them, we will begin to find a lot of these that are dropping off. Like here we had our Wyckoff scenario. Maybe we had some bad news. Volume wasn't super huge compared to this day. We had a nice gap, and we just haven't stopped. And so that's what we're looking for, is relative underperformance. Now, one other area we can do, I'll just go over here real quick, is to use another feature that we talk about, and that's the sector summary. What we can do with sector summary, we're talking again about relative performance, and we typically use this on an upside. So we can set the sector summary to say a 3-month. Normally what we would do is we'd look for the best of the best, and we'd click the top row and we'd find the best of the best. We can do the inverse here. This is sort of what we're doing with that scan. We're going to go down and look at energy's not been doing well. Oil services has been doing the worst in that group. And then we can go down and we can look at who's in the basement of the oil services. So we can go scroll here. And this is where we're finding some potential shorts, because these are really the worst of the worst. I mean, 98%. Okay, that's if you shorted that, you were probably looking pretty happy. But this is another way you can use the user interface and not the scan engine, try and at least find sectors and industries that might be exceptionally weak. So we'll go back there. I'll cover that guy up. We'll go down to our next one. This is a relatively new feature that we put in called Streak Down, and it basically says, I'm looking for stocks that have consecutive numbers of down days, or in this case, we're looking at the close. And so what we're going to look for here is stocks that have been down every day for at least 7 days. So they're just on us, just straight down. And again, we can change that number. We can, if we want something that's maybe not, if we maybe make that number too big, we might have missed it. If we find something that's been down 10 or 12 days, well, maybe we've got most of that downward action. So maybe we can find something that's down only 3 or 4 days, and then again, put it into a chart list and continue to monitor it. But that's another excellent way to find stocks that are just getting no love at all. Another downtrend. Another thing with the scan engine we can do with the results sometimes is to sort by the sectors and industries, and sometimes that'll give us another interesting clue. It's like we may find areas that are particularly prevalent within this. We can say, well, maybe we've got a lot of industrial presence and a lot of financial presence and consumer discretionary of stocks that have been going down for days and days at a time. It just gives us another idea of where in the market can we look for weakness. And like Tom was talking about, the banks have been getting hit. And we've got, again, some extra evidence showing us that a lot of the financial distress is happening in the financial industry. Okay. Another idea very similar to this is, like, sometimes we'll get a break. We'll get that 300, 400 point up day as just a relief rally. And then, as in what we've seen recently, sadly, it doesn't last. So if we have a streak, we may have 4 or 5 days in a row, and then we have a up day where it even just goes up a penny and it ruins the streak, and then it goes back down. It wouldn't get caught by our streak, but we can do count up, count down. And that says over the last 20 days, how many times has the close gone down? What we're looking for here is say, I want to find something over the last 20 days, it's gone down 14 times. So that's basically what 75% of the last month these things have been dropping. Again, here we have a very similar sort of a Wyckoff drop. But look, you can look at this action as it led up to it. It was basically down for most of a month. And so again, the count up, count down, when we're using the count down, we can change that number. And we can, as we change this, of course, we're going to get fewer and fewer numbers, but we can get worse and worse as we go. See how far we can go before we start to run out. 16 or so. I mean, there's your, if you're a short person, that's a perfect sort of pattern to see. I mean, we've got moving average crosses, we've broken support, we've got massive volume all the way down, and we've just gone straight down. We had one little relief day, got a little bit of a relief day today, but that's just ugly. But if you're looking to short, if you short at 13 or so and you're down 11, you've made, 10, 15% in the space of a couple of weeks. Okay, we're going to go down to our next one.
Hey, Bill.
Yes.
When you, when you're looking at the market and you start to see breakdowns in the market, you feel like shorting is the way to go. Do you short individual stocks? Do you trade inverse ETFs? And I know we've got a poll running, and I encourage everybody to answer that so we can, discuss that in a little bit. But what's your strategy when you're feeling bearish and you believe that there's a better chance the market's going to go lower?
I tend to just sort of take some of my riskier stuff off the table, raise a little cash. I haven't done a lot of individual shorting. I've tried doing the inverse ETFs, but one of the things I've found with the inverse ETFs is, well, first of all, they diverge from the index they track over time. So they are a very short-term mechanism. You don't want to hold the inverse, NASDAQ for 3 or 4 months. It's just not going to match the performance. But the other thing I found trading those is that very often what you'd like to see is a nice sort of U-shape or a J-shape action where you get a nice downward and it kind of slows and it kind of goes sideways and it slowly inches up and you go, okay, I'm just going to leisurely take my profit. Mm-hmm. I found it's very V-shaped. It often comes down, it hits something, and it bounces very quickly. And if you didn't get in or out that day, you've sort of lost your window. And so I've played with that for a while, and I've just kind of determined I'm not very good at it.
That's actually a good point, because there are some people, I agree with you. I struggle on the short side because I can stick with a position and kind of be sane on the long side. But the short side, if you're shorting and the market starts going against you, I don't know about you, but for me, it's it's very emotional. And
yeah, go ahead.
I was just going to say, and I'll get out pretty quickly, and then of course it goes right back down again. But I tend to have a very, very quick trigger finger. I mean, I have a quick trigger finger anyway, but especially when I'm shorting. I don't know if that's a problem that you have as well.
I've got a little section at the end that's sort of that I've some just observations, and that's one of them. And this is sort of a dangerous thing, and I'll go over a little bit of some of the dangers just in a bit here.
All right. Well, thanks for letting me ask that question. I'm sure some others were probably sitting there wondering the same thing. How you?
Sure. If you or Aaron have questions in the middle, fire away.
Sounds good.
All right, so this next one is, I'm just going to look at the Bollinger, but this can be sort of extended to any sort of channel. Bollinger is probably the most popular, but this could work with Keltner channels, which uses true range, and it could be with price channels or moving average envelopes. It's the just idea that there's some sort of a channel, and we've basically broken through the bottom of it. So we're going to run that. And I'll talk about another little minor feature that some people may or may not know of. I mean, most of the time we hit this little link here to go to our sharp chart. This link next to it, a number of the scan indicators, we can determine that we have the ability to determine your scan that you've used, particular ones like Bollinger, some of the more popular ones. And we can create a chart with those indicators on it because that's what you're looking at. So maybe your default chart style doesn't have a Bollinger Band on it, but since you're scanning for a Bollinger Band, it'd be nice to see the chart. So sometimes if you click this and it's one of the indicators that we can recognize and put onto a chart, you can click that and we'll give you the Bollinger Bands so you can actually get more of a visual of what you just scanned for. So everything here we've broken down through the bottom Bollinger. So that's a nice little feature to try. And again, this is another way to finding something that's been relatively underperforming. That's what happens if we do our regular sharp chart. But this is again that Wyckoff scenario. We've had the massive selling, huge drop, and then we've sort of continued to inch down. Maybe we're having a little bit of a leveling here, but it still's got a pretty good setup for a short. All right, and I think the last one here I've got is a percentage, and this is just a pure, how much has this thing gone down over a certain window? I'm just looking for anything over the last 10 days that's gone down more than 10%. And again, another sort of clue is you can see how many results do you get. It's like, wow, 10% in just the 2 weeks. And there's 400 of just some of the US stocks. So again, we can see a pretty significant drop over the last 2 weeks. So we've gone from 32, 33 down to 28 in the space of a couple of weeks. We had some relatively high volume, and these scans are just sort of an introductory, just some ideas. You can always put additional parameters in. You can look for volume that's much larger than average, like we did with the Wyckoff scan. You can sort of combine some of these. Of course, the more you add, the more selective the scan gets. At some point, you're eventually going to run out of things. So it's a little bit of a art to find the sweet point of what sorts of criteria you want to put in, but still get results out of it. We could also look at other indicators such as RSI and stochastics, chandelier exits. There no shortage of the ADX trends. There's no shortage of ways to start to find shorts, but I just thought I would throw out some of the ones that I found would be what I think would be useful in looking at the patterns. And what we can do, let's go ahead and go back to our scan results here. And so this is just sort of the initial setup. And like I say, you probably don't want to just run right out of the scan engine and short something immediately. So what we would probably do is say, okay, let's store these guys. Got 400 of those. It's going to take a little bit to load. So now we've got a list. We can look at this in our other views. We can look at seasonality. We can say, well, maybe this thing is really bad in the fourth quarter. So that's a plus for shorting. We can look at our RGs. We can look at all sorts of our normal favorite tools. But the other thing we can do is once we have this, we go back here. And I'll just refresh this. Is that we can create a scan. Let's just do a new one here. Let's see here. Just to reset. And we can now come down and we can scan our list that we've already got. So I know this is something that both Aaron and Tom will do. You'll take a group that's passed one set of criteria, and now you can run subsequent scans on it. So we were talking about, well, the Wyckoff setup, it's dropped, but we don't want to necessarily bite yet. So maybe we take all of these are our losers. These are the worst of the worst. And we can write another scan that says, okay, now take those and show me anything that's got a further 5% drop or has dropped another moving average or any of our other technical indicators. Those scan results are sort of like our second tier. Those are the ones that are saying, okay, I thought it was looking bad and I'm right. So that group, when you scan that group, that may be the group you want to start to say, okay, this is really where I'm ready to put my money in and start to make a move. So using a secondary list and putting a sort of a second factor into it will help weed out some of the ones that may not work. And you've just increased the probability, as Gaddis would say, Gaddis Rose. And now you found a list that's a little bit better chance of going where you want. And on the cautionary side, as Tom said, now what you've done here, remember, is you've borrowed shares and you've borrowed them at our fictitious $20 a share and you want them to go to 15 or 0. I mean, your best case is the thing goes out of business and you don't have to pay anybody back. That's pretty rare, but in 2008 it happened. So when you were in 2008 and you owned Enron or Lehman Brothers or Washington Mutual or something, if you owned 1,000 shares at $20, your maximum loss risk is $20 or $20 a share. It goes to 0. Can't go any lower than 0. It's not going to start digging. Not true when you short. You've bought something at $20 a share. You have to pay it back. If that thing starts to go up, you're losing money, and there's no limit to how high it can go. So what you've heard of the term of a short squeeze or knowing the short interest, in other words, how many people are shorting this. What happens is if something comes out, a good earnings report or an upgrade, downgrade, something happens that causes people to start buying the shares. Now you're trying to cover your shares. You say, I better go buy my shares back and replace them. I'm starting to lose money. The stock's going up. The more people have shorted, now you've created more demand. So that stock starts to go and rise. Other institutions and other individuals may say, hey, this is starting to rise, so I'm going to now buy. That puts more pressure on. That causes more shorts to get knocked off the fence. And it sort of can form a vicious feedback loop. And that can cause a huge, huge spike. And that's what you hear about talking about a short squeeze or short play. And probably the most notable one was about 10 years ago. And I'm probably a little rusty on the details, but essentially Volkswagen became the most valuable company in the world. It's 2008. You're looking at a company that has massive overhead, huge debts and infrastructure. If they're like the US, the automakers have huge pension obligations. And it's 2008, you're selling a product that no one wants to buy when they have no money. So Volkswagen was shorted, I think 15% of the shares were floated, of the float were shorted. And the average was, I think, 5%. And then sort of out of nowhere, Porsche announced that over time, it had accumulated 75% of the voting rights of Volkswagen. The thing skyrockets. And in the space of a day or two, I believe it tripled in cost. In the shares of Volkswagen went up by 300%. All of those short owners, 15% of the population of Volkswagen, were suddenly selling or buying to cover their shorts. That again pushed it up, and that spiked Volkswagen to be the most valuable company in the world very quickly. And people lost millions and millions of dollars because, going back to our example, you borrowed at $20 and you're going to pay it back, but suddenly the stock is at $60 and now you're down $40,000. And this was overnight. And some of those were people playing with a lot more than just 1,000 shares. So this can be extremely dangerous. So if you are shorting, I would say ease into it, short very small amounts. And from the StockCharts side, I would have price alerts. You really want to be on top of this, because if it goes the wrong way, a lot of people want to short things like pharmaceuticals, expecting a drug trial to fail. If that drug trial doesn't fail, you could be ruined. So, and it may come out of nowhere. So this can be very dangerous. Sometimes it's better let the ETF funds do it. It'll be a little bit more diversified. Shorting individual stocks can be very dangerous. So that's sort of the word of caution on shorting.
Yeah. Also, Bill, when you're shorting, and I don't know all the dynamics when you talk about the different brokerages. I mean, sometimes you could try to short a stock with Schwab and they'll allow you to short it. You try to short the same stock with TD Ameritrade and they'll tell you that they don't have any shares available. So it's not like, you can do this everywhere. Some stocks are shortable, some stocks aren't.
Right.
A lot of things that, can be kind of frustrating too when you go to short. And think about this. I mean, I'm going to put this in a really simple explanation, but let's say that there's a brokerage out there and you want to short 100 share, or let's say 1,000 shares of Intel, and they have 1,000 shares available to be shorted. You don't have to go contact the other owner and say, I want to borrow your shares. I mean, it's all handled at the brokerage account. So anybody who's new to shorting and wondering how this is all handled, the brokerage will either allow you to short or they won't. And sometimes it'll just come up and say, there are no shares available. Right. But let's say there's 1,000 shares available. You go in, you want to short 1,000 shares of Intel, and now Intel, you've borrowed their shares and you sell them short. So now you're waiting for the stock to decline and then profit from it. Now, let's say Intel was trading at, I don't know, $48 at the time. And now let's say the stock's gone up to say 52, and the person whose shares you just shorted put an order in to sell their shares for $52. Well, now all of a sudden the brokerage needs those shares back that you borrowed.
Right.
And so they can force you. It has happened before to me, where brokerage has said they basically have the right to force you to cover your position at some point when you don't want to, because they need those shares back. So that's part of a risk of shorting as well. And I know that's kind of a simple explanation, but and there are ways to protect your shares too from allowing others to borrow them to short. For instance, if you put in limit orders for your stock, if you're like, hey, I don't want anybody shorting my stock. I don't want anybody taking the price of my companies lower. I own them. So you could, and I don't know all the rules. It's been a long time since I've really looked into it, but I believe if you put an order in with your broker, a limit order that's reasonable, somewhere near the current price, I don't believe they can allow those shares to be shorted. So there are some other things that go into shorting as well.
Yes, just the general discussion should also sort of raise a little red flag that it's a little bit more complicated than it looks, and it can be a little bit dangerous. And so, yes, you can get called like that, and that's another reason to try and find a fairly liquid stock. The probability of something like that happening on something that's thinly traded would be higher. And of course, thinly traded, you'd have wild moves, which could go in your favor or go against you. But if it goes against you, it could go very badly. It could be a Darwin Award winner pretty quick.
Yep. Yeah, that gets scary.
Yeah.
I have to give you a little homework, Bill, because everybody wants the scan language of the scans you showed. So I'll need those for the recap.
Oh, okay. Yes. Yeah, I'll put those out there. And what I can also do here real quick is I'll see if I can stretch this out, and then people can look at the recording and or freeze the frame here. And okay, I've got the little hashtags there at the beginning, basically comment out the line, so I can basically turn things on, turn them off. And like I say, all of those, you can change those numbers, dial them up, dial them down. If you get 400 results and you want 25, change the numbers, see where you go.
That's one of the most useful things of the scan sometimes, is just kind of playing around with it to get something to fit, what you're looking for.
Right.
Excellent.
Right. Thanks much, guys. And everybody have happy, safe holidays out there. I'll probably talk to you in the new year.
Yep.
Yes.
You, Bill. Thanks for coming by.